If you look at the debt to GDP over the last 5 years in UK, in Germany, in France, in Italy, in Japan, it is skyrocketed. It just skyrocketed, Adam. It's going exactly the wrong way. The United States also, of course, has been going the wrong way. So and we're in Canada and we're having no economic growth. In fact, we have seen a shrinkage of GDP per capita because we've increasing so much immigration into our country and the GDP isn't growing. So on a per capita basis, it's shrinking.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Very pleased to be sitting down today with Jonathan Wellum, the head of Rocklinc Investment Partners. This is one of the financial advisory firms endorsed by Thoughtful Money. Specifically, they are endorsed Canadian provider. Jonathan, how are you doing today?
Doing very well. It's an exciting day. We've got a new record close on the Comox Gold, over $4,000, I think, the last I looked, just right before four.
And Jonathan, I know that gold futures have crossed 4,000 an ounce. Has spot itself crossed 4,000 yet? Do you know?
Spot was trading just a few moments ago at 39.80, 39.80. So very close, up about $20 today. Again, just before the close.
All right, spitting distance. Well, look, folks, we're going to talk about a lot of things today. Jonathan was very kind enough to drop what he was doing and come record with me today. It's a Wednesday. This was supposed to be one of Stephanie Pomboy's appearances. She's had a couple of curveballs that she's been having to deal with. She feels terrible about having to push out her return to the channel, but she's hoping she's going to be able to make it next week. So anyways, just wanted to let you know what's up with her, but thankfully Jonathan was willing to step in to the void here and fill it for us. So first off, let's start with the precious metals, Jonathan. So first off, kudos to you because you have been quite a supporter of owning precious metals in your portfolio for a variety of reasons, some of them defensive, but I think much over the past year plus, you'd said that you thought there was a lot of opportunity for precious metals to rise, and they have. $4,000 an ounce for gold. That is a phenomenal year so far for gold. I want to say it's up 45% so far year to date.
Yeah, it is. Well, as of the end of September, it was up about 41, but now I think it's about 46% or so year to date, which is phenomenal. I think it's the best return since 1979 in terms of an annual return. So that's that is a great return, no question about that.
No question about that. And of course, that's just for gold. Now, silver has had an even better performance so far this year, and the miners have done phenomenally well. I haven't looked at GDXJ this week, but looking at it about a week ago, it was up well over 100% year to date. And I know that the miners have been a big part of your investment strategy, is having a material percentage of the Rocklinc portfolio in a couple of really good high quality miners. I've got to imagine that has paid off very well for you so far this year.
Yeah, it's been amazing, as you would expect. Agnico Eagle has been really a major holding now for a number of years, just simply because of the quality of the management, the quality of the assets, the political stability in terms of where they're located. And it's quite interesting. If you actually look at a company like Agnico Eagle and you look at the free cash flow yield currently, even though the price of the stock has gone, it's tripled over the last couple of years. It's still trading the free cash flow yield at a higher rate than it was 3-4 years ago. And if you actually factor in maybe 4,500 gold, 50 silver, which isn't crazy, over the next year, if you are bullish on the metals, you can really justify like a 9-10% free cash flow yield in some of these stocks. What it's telling you is that they're incredibly profitable. That with the increase in gold going up a couple $1,000s here, that's all going to bottom line to really well-run companies. The costs have really been maintained by some of these firms, and the free cash flow growth is absolutely astounding, Adam. So we look at some of these companies, and they're probably trading at similar net asset values even after they've doubled than they were before, simply because the price of the commodities have gone up so much.
So, okay, help me understand then, Jonathan. Does that mean that despite as well as the complex has performed year to date, you still think it's I don't want to know if I should use the word undervalued, but that there's still plenty of potential for appreciation here because they're not overvalued, at least?
Well, what's happened? Yeah, I mean, what I would say is the following. If you believe that gold will maintain its value in the $4,000 range and even continue to sneak up, not at the same rate that we've seen, but continue to edge up because of the global problems, economic problems, debt problems, all of the things that we can rattle off, which is why you want to own gold, concern over fiat currency, and so on, then the valuations today on some of these companies is no different than it was a couple of years ago. And so, yeah,
Which was believed to be pretty undervalued, right?
yeah. Now, again, that was anticipating a larger rise in the price of gold. But if you can buy some of these great companies at 10, 11% free cash flow yields next year, based upon say $4,500 gold, that's not overly expensive, especially again if you believe that fiat currency is going to be under pressure. If you believe that $350 trillion of global debt is too large, if you think a $2 trillion deficit, in terms of the U.S. deficit, and $37 trillion debt is way too large, and all of those things which haven't gone away, then and you think gold will continue to edge higher as a protection against your purchasing power erosion because of inflation, then yeah, I think that some of these stocks are continuing to be very good value.
All right. So you had some ifs there, and probably the biggest one was if you still think that fiat currencies are going to come under pressure. Well, let's ask the question, okay, what would make fiat currencies not come under pressure? You mentioned the debt. The debt's a big issue, but it is less of an issue if economic growth really picks up. I talked to a lot of people. There are some now that are expecting the economy might be a little bit more robust this year than it is this year, but nobody, at least that I talked to, is predicting like a boom ahead, right? So probably unlikely that we're going to have economic growth like materially boom from here in the next immediate year or two. Then the other thing that would help fiat currencies would be if the deficit spending got slashed. And I don't see that happening anywhere around the world. Even in America, where we had Doge and it was a big part of the current administration's campaign platform, largely they've basically said, we're going to take care of it. We're going to take care of it down the road, right? So the one big beautiful bill basically had a ton of spending provisions now with the hope or intent that, yeah, 3-4 years out, maybe some fiscal discipline comes into the picture. But I know there's a lot of people that still have a lot of, understandable doubt around that. So, the whole Lynn Alden, nothing stops this train. We're in the situation right now where the central planners just have to keep running bigger and bigger deficits. So again, I don't see relief coming on the GDP growth side, nor do I see relief coming on the deficit reduction side. Is there any other reason to think that, oh, fiat currencies might actually have a rebound here in terms of their value?
Yeah, when I give some of those conditions, I'm just giving them just to make sure that people understand, what could reverse. I don't think those will reverse. I agree with you 100%. We are bullish on gold and think it will continue to go up. But I'm a money manager. I'm also an investment manager. I have to manage the risk. I have to manage the expectations of clients and do reasonable asset allocation so that we're protecting people. Everyone's got different risk tolerances. But when I look at the current economic environment around the world, it is not pretty. I mean, you go over to Europe and there's virtually no, very little growth over in Europe. We just had the third collapse of the French government in the last 12 months. We've got social
Right.
problems in all of these countries in Europe. Germany's industrial production is collapsing. They're going to have to reverse their green policies. Energy costs are way too high for the manufacturing.
They all
Japan,
have to pay more for their defense now.
yes, and some of these people are saying they're going to pay up to 5% of GDP of defense, which I don't. Where are they going to get that money? I mean, Germany now is starting to borrow at a record rate, and so what you're seeing is these countries are actually going further into debt. I mean, I ran some numbers just looking around here on the debt to GDP, and if you look at the debt to GDP over the last 5 years in UK, in Germany, in France, in Italy, in Japan, it is skyrocketed. It just skyrocketed, Adam. It's going exactly the wrong way. The United States also, of course, has been going the wrong way. So and we're in Canada, and we're having no economic growth. In fact, we have seen a shrinkage of GDP per capita because we've increasing so much immigration into our country, and the GDP isn't growing. So on a per capita basis, it's shrinking. So I think the United States currently is an anomaly when it comes to economic growth. And that is because, again, you are running large deficits. Tax policy has been more favorable. Regulations are going down. Trump is attracting a lot of capital to the country. I can say that being a Canadian because it's leaving Canada and going to the US. And so I think that if you're in the US, you're actually seeing a much more robust economy, lower unemployment, 4%. We've got 7% up here in Canada. And so, my point in terms of the gold is that, no, around the world, you're not seeing great economic growth. The US is quite unique, but the debts just continue to pile up. And so I think that's going to be very favorable in terms of gold going forward. And the policies of the green agenda, the increasing costs of energy around the world, those all have to reverse before we're going to see a change in the price of gold. We're going to see a continued erosion in fiat currencies. I think it's irreversible at this point until we degrade the currencies quite a bit.
Okay, and that's sort of where I was going from here, which is your thesis about gold's continue to rise from here was, okay, one of the things that could derail it is if fiat currencies suddenly just started getting a lot more hale and hearty. But for the reasons you just mentioned, that does not seem to be a high probability event, is a diplomatic way of putting it. So if indeed prices of gold and silver still continue to hang out where they are, continue to go up from here, even at a lower rate, you're saying that the mining shares should continue performing really nicely. And kind of where I'm going with this, Jonathan, is in our previous discussions, we've talked about how a decade ago, there was not much interest in gold. And then several years ago, the central banks started buying it, beginning to really eventually see it as a preferential holding to US Treasuries, which is a pretty big and seismic shift in and of itself. Along that path, we saw the Eastern investor wake up and say, yeah, I'll buy basically as much gold from the West as you're willing to sell it to us at today's prices. We've been wondering, okay, when is the Western investor going to wake up in this? And you and I have talked about how Wall Street is really not a huge fan of gold, but at the end of the day, Wall Street is a much bigger fan of momentum and making profits. And when a sector starts catching fire enough, doesn't matter what people's ideologies are, they just want to chase, the momentum that's going on there. Are we seeing that yet in the precious metal space? Is part of gold's rise and part of the rise of the miners here, is that Western capital really starting to flow into the space? Or is this just happening organically and we still have yet to have that big tailwind of the Western investor pile in here?
I don't think that the average investor has become really increased the percentage of gold in any material way. Again, according to individuals who have been looking at this, they still say it's on average about 0.5% of someone's portfolio. So it's quite small. And when you look at the total gold space in terms of gold, companies and royalty companies, you're probably talking about maybe $600 billion in terms of market cap. That's really just a little over, what's that, 10-12% of Nvidia. I mean, it's really quite small, and it's quite shocking how small it actually is. And so I do think there's a lot more room to go. Now, we are getting calls from, this is anecdotal. We're getting calls from more retail investors saying, should I be buying more gold? Should I, be increasing my portfolio? And we hear that, clearly that's on the street, and people are starting to talk about it more. I was listening to an interview with Pierre Lassonde just about a week or so ago, and he said that he was doing an institutional run, which he hadn't done for 10 years in Europe for a company that he's promoting. And he said that only 10% of the institutional managers had any exposure to gold that he was talking to in Europe. And that's in Europe. And so, no, I think it is underweighted, underowned, underloved. And people continue to pound into the AI stocks and in the Magnificent Seven. Interesting enough, I had one of my guys at the office just run some quick numbers on, year to date gold. If you started at $10,000, just started at $10,000, gold would be trading at the end of September about 14,100. The Royal Six, we call it, would be the six biggest royalty companies. They'd be about 18,000, so up about 80%. And the Mag 7 are actually up to 11,200, up about 11 and a quarter percent. If you take Nvidia out of there, only $11,000. So they haven't performed as well this year. If you take Nvidia out of some of the numbers, even going back 3 years, you've got the Royal Six royalty companies, the top six, Franco-Nevada, Wheaton Precious Metals, Royal Gold, Sandstorm, Cisco, OR, and Triple Flag. They've actually outperformed a lot of these tech companies. I don't think the market realizes that. And if you look at some of the mining companies, I think they've got a lot more room to go. They've done well this year, but they've got a lot more upside.
So one of the things, or two of the things that have sort of hampered Wall Street from investing in this sector of late, one is its size, right? It's just a small market, and big institutional funds like to look for places where they can put lots of money. So they just tend to look at the bigger sectors. And obviously, the tech sector for the past bunch of years has had all the glory, and that's where they've been focusing on their attention. But also, I think over the past 10 plus years, and you would know this better than I, the firms have kind of gotten rid of a lot of their mining analysts, right? There's just not anybody at these companies that really follow this space. So even if they're kind of interested, they don't have an in-house expert to go to and say, well, which of the ones are best positioned or whatnot. So there's just a lot more, I think, opacity and friction preventing Wall Street from getting in here. Do you see that as being a permanent barrier, or do you think at some point Wall Street's just going to say, look, we got to get in this game. These things are doing too well?
Well, Wall Street will chase the profits, and so I do think that there's going to be more coverage, and people will step into it. I mean, Goldman is pretty active in the space. J.P. Morgan. So you are seeing reports coming out from those companies and some others. But it's still a small space, so they'll look at the economic viability of covering the space. But like anything, if it continues to go, if this goes for a number of years. And again, not at the same rate we saw this year, but if it continues to go higher, gold, simply because fiat currencies are under massive pressure, as we've talked about, that's not going to go away. People will look for protection. They're going to look for a hedge. They're seeing that also in the cryptocurrencies and Bitcoin and so on. Then I think you will get more people coming into the space and following it. The other issue that has been a big one is just index investing, and you don't have many of these gold companies in the index. You really just Newmont. And so, they're not being picked up by these massive flows that are going into the index products and some of the ETFs.
Yeah, that's right. They're sort of left out of that game. So I think you've answered the question, but I just want to put it fully on the table. Is there anything about this mining sector that might preclude this expected tidal wave, if you will, of Wall Street capital flowing into this space at some point? Because it's so small or so opaque or whatever. And I guess what I've heard from you is no, if it keeps performing like this, eventually Wall Street capital will find its way there. But I just want to make sure.
Yeah, and you don't need to have every firm following it. So there might be it might not be comprehensively followed, but if you just have a couple of the major players, that'll be enough to shift money into this space and really ratchet up some of the prices very quickly. So that's what I would anticipate, even if it's not broadly covered. It's going to be impossible for some of the major players not to continue covering it and covering it more in depth. And so I would see that the ability and the probability of a large uptick in over the next couple of years is still there. Yeah.
Okay. So I've asked you this variance of this question in the past, but given the small size of this space, there is a question which I'll ask you, so I'll put on the table right now, is about silver. Is silver in any way is it an AI play in any way? And the reason why I ask that is silver's, as far as I know, it's the most conductive element out there, the most conductive metal out there. We're going to need to be dramatically expanding our electrical grid so that we can build a ton of data centers. There's presumably going to be silver used in a good chunk of that. I've asked this question to other precious metals guys before, Jonathan, just so you know, and they've said, maybe copper's probably the better bet, which I agree with. There's a lot of copper that's going to be needed for that. But where I'm going with this is there aren't that many pure play silver miners out there, right? So I just looked up the market cap for First Majestic, which is one of the largest silver, more or less pure play silver miners out there. Its market cap $6 billion. I mean, why wouldn't a company say like, an Nvidia or, somebody who's just got gobs of cash, big cash position on their balance sheet and just say, you know what, I'm going to buy that company. I'm going to lock up that supply. So at least I have it if I need it commercially. But also if this thing's got a big tailwind at it, that could be a good, asset on the books for the company. Why, or just a billionaire? I mean, there are billionaires out there right now that have 50 billion, more. Why don't they just buy a ton of silver or whatever and just take a big chunk of it off the market or buy some of these players?
Yeah, I mean, I think those are all possibilities, Adam. That is the reality. I'm going to be doing a presentation in a day or two up in our capital city in Ottawa in Canada, talking about just this resource boom as a result of AI, digitization, robotics, EV, all of these things, which is really causing a large uptick in energy demand. And according to my research, and I've gone into this fair detail, they're talking in the next 25, 30 years, we're going to need about 100% increase in the silver content. So that's fairly substantial. I mean, copper, you're looking at about 80%, which is in 20 years, which is very hard to come by. So I think silver, copper, yeah, there will be a large increase in the demand as a result. Again, if these trends continue because of AI, robotics, digitization, EVs, batteries, all of these things, silver is going to be very important. And as you know, it's pretty tight market now. It's very tight market at this point. I mean, some people say, again, there's been not enough production really to meet the demand, both manufacturing and for the precious metals monetary side of it. So I think it is incredibly strategic investment on two fronts, both in terms of the green technology and for energy, and also for as a monetary unit. And so I think it's quite possible you're going to see strategic investments in these companies. We're seeing that in other metals. The US government now has bought into Trilogy. I mean, they're trying to get into rare earths. So I think, yeah, this precedent is being set. And this would not surprise me at all to see strategic investments in some of these companies. And they are, as you say, relative to the market cap of some of these AI companies, it's nothing. It's a drop in the bucket. And these companies are create a lot of cash flow. So yeah, I would expect potentially more of that. And copper's another one. I mean, it's growing 3-4% a year. And as you know, to develop a copper mine, it takes 10 years plus. It takes tens of billions of dollars. And there's not very many places where you can find these massive deposits. And in some cases, as we saw in Panama, and Cobre mine there, it was actually shut down right at the time it started to produce. But even there's so much pressure to get that open because the government needs that revenue, needs that money, and we need the copper. So I think, yeah, some of these things could materialize over the next year, in a couple of years, because of the increase in demand and the strategic nature of some of these metals.
Okay, so there was a billionaire who Twitter was abuzz with this, or X was abuzz with this a few weeks ago. David Bateman, I think was his name, and he bought, I would say maybe $1 billion worth of silver. I don't know if it's quite that much, but it was a lot. Definitely closer to $1 billion than not. And to me, that was sort of evidence of what we've been talking about, which is, hey, why don't some of these guys just buy a ton of it? And there's not that much on a relative basis above ground silver. And so you could really take a lot of supply off the market right away. Now, that might be a reason why silver is continuing to have the run that it's having. But I know I'm asking you to guess here, but what do you think would happen to the price of silver if, say, an Nvidia or an Apple just bought First Majestic? Like, what do you think would happen the next day? Where I'm going with this is, like, not only would it be potentially a good strategic asset for you to have, but you might be able to like double your money in a week. You buy it, the market freaks out. Yeah.
Yeah, I mean, look, I think the longer term trends mean that silver go triple digit anyway. But I think it would go triple digit very quickly, which is at this point would be a double very quickly up into the hundreds of dollars. And that's not crazy thinking. That's I think very reasonable. You remember Warren Buffett? He bought a lot of silver back. It was like 97, 98. I remember going down to the annual meetings. People said, "What the dickens is he doing buying silver?" But he was told later on. He did say that the U.S. Treasury told him to get off of it.
They tapped him on the shoulder.
Yeah, they give him a little tap and say, "Hey, Warren, we like you, and you like to get along with us a little bit better than get off that silver." And so that was the strategic. He saw that. He saw how tight the market is. And so if there, demand comes in to the marketplace, and it's going to, because we're going to need more and more silver. And again, the silver production is not growing that quickly. Again, you talk about us, First Majestic and Keith Newmeyer there. I mean, he'll rattle off all the stats on silver, and it's a tight market, and demand's going up. So, and it's in countries which they're always fighting to get it out of the ground. There's issues in
Right.
Mexico, different places. It's not in easy places either. So yeah, no, I think there's a lot of upside potential in silver, and we maintain some silver exposure in a number of the companies we own, and also in some of the royalty businesses, they have exposure to the silver. Yeah.
All right. Well, just parting point on this. I think the metals that are essential to the build out of America's, or actually most countries, the rebuilding of their energy, their electrical production capacity, have an uncommon tailwind behind them. And the reason for that is when you compare our electrical production capacity to China's, they are leaving us in the dust. There's a chart. I'll try to find it to put it up here when I edit this, Jonathan. I've showed it before, but the US's electrical production capacity has basically been flatlined for the past couple of decades. China has super invested in this space. They're now way ahead of us, and our line is like a horizontal flat line. Their line now is almost like a vertical line. If we want to win the AI race, which I think we have all said is a sovereign existential priority for the US, we have to be a winner in providing plentiful, cheap electrons to the AI data centers. So we could even go through, I think, a big bust of the AI bubble market value wise, where the market says, you know what, we price these stocks way too much. We're going to cut them in half by 50+% or whatever. You could have kind of a wipeout like that, like the dot-com era. Even if we do, and that would be very painful market wise, I don't think that's going to stop the build out of the electrical grid, because I think that is market independent. I think that is the US and other countries too, but the US in particular saying, we must win this, just like we had to win the nuclear race. So we're going to do whatever it takes. And that build out is just going to place increasing amounts of demand on these metals, the copper. You probably know some other ones more than I do that will be
Yeah,
needed for
new
this.
nickel, cobalt, lithium. There's a whole host of them, really. Quite, yeah, a large assortment of them at the end of the day. Some more difficult to acquire than others.
Right. So I think as long as winning AI remains as important a sovereign strategic objective as, say, winning the nuclear arms race, these things are just going to have, I mean, almost infinite demand over the next decade or so for them. And, as Rick Rule has been warning us about a lot with a lot of commodities is no matter what happens going forward, demand goes up, demand stays flat. We have underinvested a lot in the CapEx in these industries and in building the mines, doing the explorations and stuff like that, so that we could a very high probability of some of these key resources be entering into shortages. Hopefully those will be, the shortages will be cleared up over time, but that may take years once they manifest, to your point, because you can't just turn on a mine like that. It takes a good while. So anyways, it seems like the investment thesis behind the metals related to the electrical build out play seems to be one that we can have pretty good confidence in. Do you feel similarly?
No, I agree 100%. The underinvesting has been, I think, largely due again to this whole green ideology that we've seen across the world. And I mean, you see it with Germany. They shut down their nuclear facilities. Now they've got to get them back up again. They think they're going to rely just on solar and wind and so forth. It's not doable. In Canada, I mean, again, I'm going back to my own country. What we've done is we've bypassed best estimates about $700 billion of capital that should have been invested in the resource sector over the last 10 years alone. That's like $1.5 trillion of GDP. And so this underinvestment in the resource sector isn't just in Canada, it's just not over in Europe. It's really been around much of the world, with the exception, of course, of India and China and Russia. They continue to go full steam ahead. And in the US, It was under a lot of pressure again in the Obama years, and of course under Biden. Now Trump is reversing that, and he's putting on a big push to get the resources developed, drill, baby, drill, get the rare earths, make sure you're not vulnerable. And I think that is going to help kick up, some of the production in some of these areas. But as you know, it takes years. It takes years, and the United States can't do all that on its own. So other countries are going to have to get their act together also, or they're going to fall very far behind. If you look at the data centers, I mean, there's about 12,000 data centers in the world right now. The US has about 40%, 45% of them. And they anticipate, again, these are estimates, but it gives us a direction to go anyway. By 2050, we're going to have 90,000 of these in the world, and they're estimating, because of the U.S. leadership and the best place to put money and attract capital, that you guys will have like 55% or more, 60% of those data centers, and that would be phenomenal. But you're going to have to put trillions into the grid, no question about it. And that's why I think Google, Amazon, and Microsoft and so forth are doing these deals to make sure that they're securing the energy as they build these facilities out. Yeah. So
yeah, and then my point, like I just don't understand why they don't do deals to secure the mining supply and just like literally buy
well,
some.
that's probably coming, Adam. That's
Yeah.
probably coming. Again, I think you've hit on something there. And if it's going to be profitable and it's strategic and it's not going to be very expensive for these companies to swallow some of these productions and secure it, it'll happen. It'll happen.
Okay. So obviously you guys have had your positions in the precious metals space for a while. Are you also positioning for some of these trends that we're talking about here, whether it's AI, whether it's the metals demand on the data center build out, et cetera? I mean, are these things that you are looking at in your portfolio construction?
Yeah, we tried to get exposure to copper. I mean, copper, I think a lot of people have talked about that. We're not geniuses when it comes to that either. I mean, copper is incredibly strategic, very, very hard to come by though in terms of growing it. So copper. We also get exposure to some of the companies building the AI facilities. So we have some exposure to Brookfield. They're building some of these data centers. Snyder Electric, which is again also building some of the data centers and contributing, parts, equipment into the electrical grid and things like that. So yeah, we are trying our best to look at this space. We don't have any Nvidia, and so we've missed some of the high flying ones. But we are trying to buy, the picks and shovels, if you will, of the industry. Those guys who are going to build it and be able to take advantage of it on a number of levels.
Okay. All right. And when you talk about playing copper, you buying the metal, you buying I'm getting a guess probably not, because you're more of a Buffett type. Let's find a great operator. Is it the big guys like the Freeport McMorans, or I mean, who are you looking at?
Yeah, I mean, of course, we maintain a very large position in Franco. We're hoping that that will come back online. The Cobre Panama property will come back online, so we got some exposure there. And then we're looking at some smaller, more focused miners also, and see if we can't get some better exposure also to the copper.
Okay. And speaking of copper, again, you're in Canada, but in America, I forgetting which state this is in. It's in the West. But there's the Resolution mine, which I think has been like 30 years in permitting. I mean, just to show you kind of how bad or how crazy it has gotten in even in the US to open a mine, right? But apparently, if I'm remembering Rick Rule correctly, this is one of the like best untapped copper deposits left around. You're nodding as I'm saying this. So with the Trump administration kind of getting into drill baby drill, I've heard him say mine baby mine as well. Could something like that come into play? And who owns it? I think maybe Rio Tinto owns part of that.
Yeah, I'm not sure. I mean, I've heard Rick Rule speak about it and followed it from that perspective, so I'm aware of it there. But I do think that what you're seeing with Trump and his cabinet is that they want to unleash the mining sector. Also, you have to, and the rules, the bureaucracy that you go through in Canada. We had the Trudeau government, which we've had for 10 years. Now it's transitioned into the Carney government, which is the same government, but just a different leader. I mean, they actually put roadblock up after roadblock after roadblock after roadblock. Instead of 2 to 3 years, it comes 10 years, 12 years, 15 years, and the capital just disappears. So you have to take the regulations down. Again, you want to make sure they're looking after the environment, they're being good stewards. That's not the issue. You just don't tie them up in unnecessary red tape. And that's really what the bureaucracies have been doing. And no, I think you're going to see a lot of changes with Trump. And you are seeing those changes, and hopefully that will put pressure on other regions around the world. They're going to have to need to compete. Otherwise, you're going to have a rip roaring economy in some areas if you get all this capital going in the next couple of years.
Right. And this isn't, a pro-Trump type of thing, but I think what you're saying, Jonathan, is just countries are waking up to the fact that, look, resources are, the foundation of prosperity. And if we want to get to where we want to go, we're going to have to really make the best use of the resources we have, right?
You're going to go on the internet and you're going to use Grok and you're going to use, different AI, and you're going to have robots in your house like Elon Musk is talking about, and you're going to have, automated systems and, electric vehicles. You need to dig a lot of holes, and you need to expand your mining industry dramatically. So this idea that somehow, you don't have, can be green and you can drive your Tesla and you can live on the internet and you never touch any dirt is just ridiculous. In fact, we have to do more mining and more development, more exploration, and more production than we've ever done in human history by far, if we're going to continue the trends that we're on right now.
Okay. Real quick, I looked up the Resolution Mine. It's in Arizona, and it's a joint venture between Rio Tinto, which owns 55%, and BHP, which owns the other 45%. I also just looked at the Rio Tinto stock price. It's done okay this year, Jonathan, but not gangbusters, not barn burner. Do you look at companies like that and think, hey, that's something that's getting overlooked right now by the greater market?
We are spending. We're actually the next month or so. We've got a couple of our guys just looking at the copper sector more. I mean, you got McEwen Mining. He's got some interesting copper assets, and some of the other businesses like Rio Tinto, Tech, and so forth. So we are looking at a number of those companies. They're tough businesses, yeah, and they historically have not created a lot of wealth over time, and that's what makes us a little more hesitant versus the precious metals and some of the clearer cut commodities. And so that's what makes this just hesitant. But we are looking because the demand factors and the pricing factors will work to their advantage, and there could be a nice trade there for just a couple of years where you can buy them relatively inexpensively and then sell them in a couple of years. I mean, we're value investors. We like to own 3, 5, 10 years. Your best holding period, according to Buffett, and we agree, is forever. But those aren't businesses you really can own forever. So you have to be careful. The other sector that's been beaten down, especially in Canada, and probably for good reason, is the oil and gas sector.
Oil, yeah, same in the U.S.
Yeah, and so we're looking at that area, and even in the tech area, we're quite amazed at some of the software companies have not done very well. You get Constellation, you have Roper, you've got there's a Tyler that does a lot of municipal software. They also have really lagged. You've really seen just the money really going into anything that's AI related. So I think that's going to create some opportunities for investors to look at non-AI related sectors that have underperformed, not doing as well, and yet continue to grow their businesses and do quite well.
Okay, well, so let's talk about oil and gas for a second, but particularly oil right now. What barrel oil is low 60s right now?
Yeah, I guess the WTI is trading about 61, 62. Okay.
And the stocks haven't performed all that great of late. And this has really been catching my attention. Look, there's a lot of reasons right now why oil is as low as it is. It's getting below the cost of extraction. And so, it's going to be challenging for Trump to have all the drill baby drill that he wants to have happen, because a lot of these companies are like, it's just not economic for us to go do that right now, right? So they're going to resist that. The oil industry in general is a boom bust industry, right? We know it has these cycles. So it's clearly right now seems to be in a down cycle. Now, could it go lower? Sure, absolutely. But it should come back unless world demand for oil looks like it's going to change. Looking at it, world demand for oil, Jonathan, I don't see that happening anytime soon. I mean, the oil demand year after year after, as much as a lot of people would love for it not to be the case, the world still runs on liquid hydrocarbons.
Absolutely. And again, I go back to, I'm going to be doing a presentation in a day or two up in Ottawa and looking at where the energy is going to come from over the next 20, 25 years. And most of the projections would have us at 100 million barrels a day 25 years from now. I mean, it really doesn't drop much. Some have it up to 120 million barrels a day, some down to 80, depending on where you stand on net zero and how that all gets implemented. But the basic projection is to continue using as much oil as we're using today. That's our best guess, and I think it actually could edge higher. It's very difficult to get around the fossil fuels, and the natural gas, as you know, is quite clean and very plentiful, and we've got lots of it up here in Canada too, as you have down in the United States. And again, that's going to be used to again to power a lot of these data centers.
These data centers, yeah, exactly. So on the oil side, what's really
It's cheap, and it's really cheap in Canada. It's like just a couple bucks. I mean,
right.
We turned down opportunities to sell it to Japan and over to Europe, which Donald Trump was quite happy to fill in for us. And we could have been making, selling for $2-3, and well, selling our cost to be $2 to $3, and selling it for $10-12. It's insane the opportunities there are in terms of that. Yeah.
Okay, so I actually want to get to that specifically in a second, but on the oil side, it's cheap right now. Prices are depressed. The industry will likely not be drilling aggressively, increasing supply until price recovers. So essentially, it just means we're likely to have even rising odds of some sort of shortage in our future here. And again, this is one of those sectors Rick Rule has said we have underinvested in CapEx for a good long time, and those sins of the past are going to catch up with us, even if demand doesn't grow, which it likely will, as you said. But my point is this is a time where you can buy stocks like the blue chip stocks in this space for really deep discounts and get paid handsomely. They're good dividend providers. So to me, this kind of feels like the situation a couple of years ago, buying some of these quality, like the Agnicos of the world, right? Where they were really attractively priced. You got great management, you got a really quality company, but at a really good value, except you get paid more. You get paid a lot more to wait now, and you still have that upside ahead of you. So I'm curious, does it feel that way to you? You're a lot more experienced than I am in investing in this space.
Yeah, no, absolutely. I mean, we've had Canadian Natural, Suncor. We've also had a Meg Energy. We had a pretty good position in Meg Energy. Unfortunately, they're selling their business. They're being bought out at what we believe is a very inexpensive price. But these companies were generating 12, 13, 14% free cash flow yields. And so they were getting their debt under control. And a lot of them have very manageable debt. So what are they doing with all that cash if they're not investing it back into capital because the prices are too low? Dividends and stock repurchases. So in some cases, you're also getting substantial stock repurchases. So you're getting again an increased ownership in the company and a deferred capital gain basically in the stock as they buy back the stock. So
wow. Boy, as a precious metals mining share owner over the past decade, getting used to dilution, this sort of anti-dilution sounds wonderful.
No, it's exactly right. And when we looked at some, now the prices were, this is back if you get up to say $80 on some of the Canadian players, and it wouldn't be different in the US. They could basically buy back with free cash flow, the whole company in 8, sometimes 8-9 years. It was crazy. Now look, what is Warren Buffett buying? Where's he putting some of his cash to work? He's putting it in the oil and gas sector.
Yeah.
And he's known to be a pretty smart investor. So
right. Somebody, I'm trying to remember who was telling me, I think Jesse Felder, he said you can actually buy shares of Occidental right now at a lower price than Warren Buffett's cost basis in it.
Yeah. Well, that happens, but and again, that just shows that even when Warren Buffett's buying, people just don't care. They're not paying attention to what he's clearly signaling, and that is very inexpensive, and he's committed to be there for the next number of years. Yeah.
All right. All right. Well, look, last question. I know we got to wrap up because you got to go. You talked about some of the, we'll call it maybe the own goals that Canada has made against itself in terms of using its resources to its best national interest. You talked about, not selling your natural gas to Japan. As I understand it, you're very oil rich domestically. Nobody argues with that. But you're very poor in infrastructure to get that oil out of Canada to other countries that would want to buy it. You're smirking as I'm saying this.
Well, Americans should be very happy that we are very inefficient with our infrastructure because it all goes down south of the border.
Well, and that's my question to you. So I know right now in Alberta, there's a huge hunger to free up the landlocked oil there. They would love nothing more than to build a pipeline out to the Pacific and start shipping it off to Asia. It does not seem like that's going to happen anytime soon. It seems like there's still a ton of resistance to that. What do you think is more likely? Canada to eventually find a way internally to come up with a way to build that infrastructure and start really exporting its own oil to the world, or once people simmer down from Trump's 51st state haranguing from the campaign, to strike a deal with America to just have a much greater increased transfer of resources between our countries?
Yeah, I think it's getting, the current government is, as we know, governments are there, is incredibly ideologically driven, and it really is driven by a radical environmentalism. And so what's happened recently is the Prime Minister Carney says that he wants to build Canada. He talks about building Canada. They've got this great verbiage, we're going to build Canada. And so he's come up with 4 or 5 projects that he wants to do, but none of them are pipelines. I mean, one of the most important things we need are pipelines, as you say, to be able to move the most important commodity we have in Canada, oil, out to the coast, and so we can sell it into the world market. 96% of our exports go to the United States because that's the only way we can go south. And so this is really, really hurting us. And the other factor is Carney shouldn't be deciding what projects are done. That should be done in the private sector. So you've already got top-down management by government, which means that if you're going to get any projects done in Canada under the current regime, you've got to go hat in hand to the Prime Minister and his cabinet and convince him that this is a project they should do. So that is really frustrating Alberta, no question about it, and I think rightly so. So if they don't move these things forward, I think it will feed a separatist movement in Alberta, which is already alive and well. And Alberta will do more deals south of the border, no question about that. And that could even lead to potential succession from Canada. The United States, again, I'm speaking as a Canadian, I hope this doesn't happen, but the United States would incredibly benefit massively from having a direct relationship with Alberta, whether it was just economic or whether it was both economic and political. As well as Saskatchewan. Saskatchewan's got the second largest uranium reserves in the world, active uranium reserves in the world. And it's also one of the breadbaskets in terms of its agricultural business, canola, wheat, the different pulses and so forth. So these are 2 very, very rich provinces, and they are being stymied by a federal government that won't let them do their projects. So they're, of course, going to look south of the border and look to Trump and look to other opportunities to exploit those great resources if they're going to be stymied within Canada and they can't get them to the global market.
All right. Well, speaking as a single American, our interests are, I think, best served by having a strong, prosperous, self-reliant partner to the north. But if that just is not the way the cards are falling, we would love to partner. I think only goodness would come from tighter economic partnerships with the parts of Canada that would want to partner around this stuff. So anyways, I wish you guys the best in solving it all for yourselves. But if not, I certainly hope we would be happy to play whatever role we can in helping you tap into that national treasure of yours in a way where you guys benefit the way you should from it. All right. Well, look, in wrapping up here, we only have a couple of minutes left, Jonathan. We've talked a lot about the hard assets, the minerals, the natural resources side of things right now. Let me put it this way: folks that are watching, who watch Thoughtful Money, episode in, episode out, and they like the whole pie, and for those who really also just like the natural resource side of things, If they live in Canada, and would like to get some help from you and your firm, help meaning just sort of some direction, some feedback on their personal situation and what they should do given their investment goals, what are the ways in which Rocklinc could help them out?
Yeah, no, we've had a number of listeners, Canadian listeners, through Thoughtful Money, come to us, and we will have a conversation, talk, look at their existing portfolios, see what look at their objectives, get to know them in terms of the risk tolerances, and suggest portfolios for them in terms of how best to manage that money going forward. No pressure, there's no cost to that whatsoever. Come in, listen to us. We've got some fantastic team members, and we love talking to the different clients and giving them some long-term options in terms of how they can protect their capital and grow it. Despite the challenges, there's lots of challenges out there, but you can't hide your money under a mattress. You have to have a program, and you need to have a good idea of where you're going, good investment strategy.
All right. Well, look, in wrapping up here then, folks, if you'd like to get help from Jonathan and his team there at Rocklinc, if you live in Canada, or if you'd like to get help from Thoughtful Money's endorsed U.S. partners, if you live here in the U.S., feel free to reach out and talk to them by filling out the very short form at thoughtfulmoney.com. These discussions are free. It only takes you a couple seconds to fill out that form. There's no commitments involved. As Jonathan just said, they'll just do whatever they can to be as helpful to you as possible. That being said, too, folks, don't forget that Jonathan is going to be participating at Thoughtful Money's Fall Online Conference, which is now coming up in just a week and a half. So if you haven't bought your ticket yet, go buy it now at thoughtfulmoney.com/conference and go quickly. You've missed the early bird discount price, but we are offering a last chance to save discount price this week before ticket prices go up to full price next week. So get your ticket on discount while you can. And if you are a premium subscriber to Thoughtful Money's Substack, look for the code that I've emailed you that you can use to get an additional $50 off of whatever the ticket price is. Jonathan, thank you so much. I know you had a busy schedule and you shoehorned this in. I really appreciate it.
Oh, it's wonderful speaking with Adam, and I'm looking forward to that conference also in a week and a half. That'll be a wonderful time to get caught up in all the different issues and the different speakers that you'll have on that day. That'll be a great day.
Thanks. Yeah, this is I say this every year, but I think this is the best faculty we've ever had, and it could not be more timely given all the uncertainty going into the new year. So really look forward to it. And again, thank you for participating. All right, Jonathan, I'll see you there, and everybody else, thanks so much for watching.
I think everything's on the table. We just have to be patient. We have to be appreciative of these prices below $40. I think once it takes out $50, it can happen rather quickly that we rally towards $75 and then maybe $100. And technically speaking, we have the mother of all cup and handle patterns in the silver market. It's a 50-year pattern there in the making. And on a linear chart, we're talking $100 price target. On a logarithmic chart, we're talking $500, $600, $700 price targets for silver. And if we look at the gold-silver ratio, you can also definitely make the case for three-digit silver. These are the round psychological numbers. Obviously, we are in uncharted territory above 3,500. And then I think down the road, yeah, I'm more or less in the camp of 10,000 gold at some point over the next few years.
Silver supply is limited since little new production is coming online, and most is just a mining byproduct. The speaker believes silver is setting up for a massive move, supported by a 50-year cup and handle pattern. Once silver breaks $50, it could quickly surge towards $75 and even $100, with long-term targets as high as $500 to $700 on a logarithmic chart. The gold-to-silver ratio also points to the potential for three-digit silver prices. On gold, the outlook is similarly bullish, with projections of $4,000 to $5,000 in the near term and the possibility of $10,000 in the coming years, with a shallow pullback to $3,120 presenting a buying opportunity. Demand remains strong in Asia, led by China and India, where cultural and safe haven buying continues to support prices. Hong Kong gold imports surged 127% in July, while China's overall consumption dipped 3.5%, though bar and coin demand jumped 24%. Chinese investors also drove record ETF inflows of 70 tons in 1 month, doubling their share of global ETF assets to 6%. In India, jewelers stocked up ahead of festivals despite high prices, paying premiums up to $4 per oz. Overall, Asian physical demand was robust, with Chinese bar and coin purchases up 44% and Indian demand up 7%. Florian mentions that gold is holding steady amid a softening US dollar and yields. Overbought conditions signal a need for fresh catalysts to break past $3,400, though the metal remains well supported. Major institutions such as Goldman Sachs and JP Morgan forecast gold prices reaching $4,000 by mid-2026, supported by structural rallies and dollar weakness. Pullbacks remain possible if gold becomes overbought or risk sentiment improves. Before we begin, please subscribe and enable the notification bell so you stay up to date.
I mean, here we are, end of August. Everything's a little bit slower. That's totally normal. People should actually spend this time in the summer with the families at the beach or at a beautiful place, taking off and like recharging, right? So nothing to worry here. Of course, last week, the big Jackson Hole event kind of like created some volatility in the markets, but I would not overvalue all these statements. I mean, in the end of the day, it's the price action. The market usually is dictating what the Fed is in the end of the day doing. So we have seen gold consolidating now since end of April, more than 4 months. Healthy consolidation on high levels. I think you and I agree that we probably both have expected maybe a bit more of a deeper correction back in end of April when it rushed to that new all-time high at 3,500. But all the market gave us was a low at 3,120. And already that looks like a buying opportunity in hindsight because gold is trading nearly 10% higher. So it's holding up really well. I think it's strongly supported by the physical demand out of China and Asia, of course. But I think also slowly but surely the Western big money, so to speak, is waking up to the fact that gold is the last man standing. And it's a clear bull market in comparison to all the other markets. You have a very strong, clear bull market in gold. And I assume that it's just a question of time until we see the next leg up. Gold is trading in a tight trading range. It's getting tighter and tighter. Over the last few weeks, it's been less than $100. We had some days recently with less than $10, $15 of a trading range. And it doesn't take much for gold to break out. I mean, already 3,400 is already the next probably buying signal here, a pro-cyclical buying signal, if it breaks above that, and it just takes another $5 from you as we speak. So it looks very bullish. It's been holding up very well. It's, I think, the most interesting and exciting market. It reflects not only the things that we just talked about, historically speaking, and when it comes to value investing, etc. But of course, it's also a geopolitical, in-depth kind of story that you can read if you look at the gold price and its development. So I think it's all looking very, very positive and promising for gold here. Usually these consolidation periods end with one little bear trap. You get one little quick nasty sell-off that shakes off all the weak hands, and then the market turns around violently and rallies hard to the upside. Maybe that's still around the corner in September, but I don't see any big downside here. I think I wrote this in Gold We Trust report in May already. I said gold is most likely not coming below $3,000 anymore, and here we are. And it's holding up very well. The only situation where I could see a little bit more of a challenging times ahead is really if the stock market would get into a deeper correction, something maybe that like we've seen in January until March with a big final panic kind of in the last days of March, early April. But whenever this liquidity suddenly disappears, and then of course gold and silver prices are also affected in the short term, but whenever this disappears, the liquidity, magically a few days later it reappears and shows up again, and then it's a buying spree within a 2-week kind of everything changes, and 2 months later you have new all-time highs in the stock market. And of course gold and silver is also strongly moving higher. So remember that sell-off that quickly led to silver falling below $30 actually was the launching pad for that 40% rally since then in silver. So it's always this mass psychological phenomenon. It's sometimes hard to time, but usually you can see in the charts more or less what's around the corner. And here we are. It looks like gold is about to break out and move higher, and it doesn't take much to the all-time high. And after that, I think we're moving to $4,000 rather quickly.
Florian points out that we are clearly in a precious metals bull market, but it hasn't reached the euphoric stage yet. Other assets like Bitcoin, tech stocks, and real estate have captured attention, while inflation and economic strain have limited many investors' capacity. Still, with ongoing money printing and global instability, gold and silver are likely headed much higher. Typically, bull markets end with explosive moves where prices double in a short time, and we haven't seen that yet. Looking ahead, continued fiat currency debasement could drive gold toward $4,000, $5,000. Rising volatility is expected, with daily price swings of several $100s possible, similar to past hyperinflationary episodes. The main concern, however, is the push for central bank digital currencies and tighter financial surveillance, which could make it harder to trade precious metals openly and potentially push transactions into black markets. Let's recall the interview now.
Well, I think we are in the bull market, right? So the surprise is clearly to the upside. Usually those bull markets end in total euphoria. I don't think we are there yet at all. I mean, you don't have your taxi driver and your grandma telling you all the day to buy gold and silver.
Your grandfather did.
So
though.
I think, yeah, but my grandfather, mom has not called me telling me
All right,
to
right
buy
on.
gold and silver. He just bought. I mean, it's another one for like usually the Joey come kind of late guys. I don't see them moving into gold like euphorically right now. I think there's so much going on in the world of investments and so many other topics. Of course, Bitcoin has taken away a lot from the gold cake over the last 10, 15 years, and the tech stocks. And also, I think many people just don't have as much money anymore because inflation and all these difficulties during the COVID period. It's a complex kind of setup that we have here. But we are in a bull market in precious metals. I think the best is yet to come. Usually at the end of such a bull market, you see that asset doubling within a few days or weeks. That's usually the signal where, oh, now it's really the top. We want to be careful and probably move into something else, but we haven't seen anything like that. I think that the Western world is in such a dire shape that money printing will prevail and even intensify over the 12 to 24 months. And that will push every asset overall higher. So I've been calling this the cracker boom for many years already. And I also described it before a little bit, like you have, in the end of the day, the depreciation of your fiat money is making sure that most of the good assets, or more or less good assets, are rising over time. So your real estate is becoming more dollar in euro. Your stocks, the good stocks at least, or the better ones, or the ones that are being chased through the village right now, are moving higher. And of course, precious metals and Bitcoin as well move higher overall. I think we're going to see a lot of volatility. I think that, and that's, by the way, if you the Weimar Republic hyperinflation, you can see how dramatically the volatility increased in the years between 1921 and 1923. So something like this is very likely, and we probably will then also see $300, $400, $500 swings in the gold price on a daily basis. But we're not there yet. That's why we should appreciate these rather quiet times right now. I think gold is probably on the way to 4,000 and then 5,000. I mean, these are the round psychological numbers. Obviously, we are in uncharted territory above 3,500. And then I think down the road, yeah, I'm more or less in the camp of 10,000 gold at some point over the next few years, simply because I assume that the money printing, the fiat money printing will continue. And in the digital and central bank kind of money that they try to push on us, that's my main worry, actually. And it's very hard what to make out of it, to be honest, because it can theoretically mean that at some point we're not able to buy and sell our precious metals within these currencies anymore, and we have to maybe go back to black market kind of situation. Who knows?
Florian emphasizes that gold and silver are firmly in a long-term bull market, supported by strong Asian demand, central bank buying, and technical setups pointing to much higher prices. While both metals may face short-term volatility, their role as safe haven assets amid fiat debasement, economic strain, and geopolitical uncertainty suggests far greater upside ahead. With projections of $4,000 to $5,000 gold and silver breaking toward triple digits, the next explosive phase of the bull cycle may be closer than many expect. Could central bank digital currencies limit access to physical gold and silver, reshaping how investors participate in the bull market? What technical or fundamental signals would confirm that gold and silver have entered their euphoric, final stage of the cycle? We would love to hear your thoughts, so please share them in the comments box below. If you found this video helpful, please give it a thumbs up, and remember to subscribe for future videos. Thank you for joining us on this adventure.
If a group of paper gold investors suddenly demands physical delivery, the counterparties will have to buy gold in the spot market since the leased gold is not in their possession. The gold market is liquid, but not liquid enough to support delivery if there were demand for more physical than a small slice of the paper gold market. A full-scale gold panic would quickly emerge. The spot gold price would go to $25,000 per ounce before an investor could yell buy. I take it that someone, possibly Scott Bessent, sat down and potentially explained the paper gold reality to Trump and Musk. Once you understand how the gold market actually works, you quickly back away from putting on a show at Fort Knox.
If paper gold investors suddenly demanded real delivery, the system would collapse fast. Since leased gold isn't actually in their possession, counterparties would be forced to scramble for metal in the spot market, but there isn't nearly enough physical gold available to cover more than a fraction of paper claims. That kind of rush would trigger a panic, with prices shooting toward $25,000 an ounce almost instantly. It's likely someone, maybe Scott Bent, explained this fragile reality to Trump and Musk, which is why they backed away from the idea of making a public spectacle at Fort Knox. Mike Maloney, best-selling author of Guide to Investing in Gold and Silver and founder of goldsilver.com, reveals that China has just issued a groundbreaking mandate requiring its largest insurance companies to allocate 1% of their assets into physical gold. This rule is being funded by reducing U.S. Treasury holdings, accelerating China's shift away from the dollar, and creating massive new demand in the gold market. At current prices, this would consume 15 to 20% of annual global mine production, an amount so large that it virtually guarantees upward pressure on prices. With mine supply stagnant, this structural demand could push gold far above its current record highs in the years ahead. Meanwhile, momentum is building elsewhere. India's pension regulator is considering allowing retirement funds to invest in gold ETFs. Indonesia is weighing limits on gold exports to preserve reserves, and Florida has legalized gold and silver for transactions. Mike Maloney, at the same time, also highlights that Japan's collapsing yen has driven gold to record highs there, tripling in value over the past 5 years. Globally, gold still represents just 0.5% of financial assets compared to a long-term average of 2%. Even a simple return to historical norms would multiply demand several times over, signaling the early stages of a potential gold supercycle. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
Physical gold mandate for insurance companies will reshape the world's gold market. So Avery Goodman, and this is also, this is just a few days old actually. So, a couple of weeks. China's insurance regulator now requires major insurers to allocate 1% of their assets to physical gold, creating unprecedented structural demand. This move is explicitly funded by reducing U.S. Treasury holdings, accelerating China's de-dollarization, and shifting global gold market dynamics. The mandated gold buying at current prices will absorb about 15 to 20% of annual global mine supply. 15 to 20% of annual global mine supply, supporting a significant price increase due to limited new supply. Yes, it would. This percentage will get smaller as price goes up. Given stagnant mine output and rising institutional demand, gold prices are likely to rise significantly above current historic highs in the coming years. Absolutely. If this demand that is mandated, that insurance companies do this, right now it's 15 to 20% at these prices. But this is like an impossible situation. The prices have to rise for that 1% of their yuan-denominated assets to be allocated toward gold. Moving on, Eric Jung, Indian pension funds might invest in gold. And this is from Bloomberg. India's pension regulator is considering easing investment restrictions after portfolio managers pushed for new ways to boost returns on a rapidly growing pool of retirement money. It's not money. This is currency, and they're trying to turn it into money, according to people familiar with the matter. Retirement fund managers met senior officials from the Pension Fund Regulatory and Development Authority in a series of meetings late last month and requested permission to invest in gold ETFs. I wish they would just invest in physical gold, the people said, asking not to be named, and so on. The regulators are considering the proposal and have sent the draft language on gold investments to the funds for feedback. So this is something that is potentially happening, and it's big. Moving on, holy smokes, Eric Jung again, Indonesia looking at reducing gold exports to keep the strategic reserve currency within its own borders. This isn't currency. This is strategic reserve money, and it's the only money. They've got a whole bunch of other fiat currencies as reserves, but this is the only money that they hold, but they want to keep it within their own borders. And this, again, is from Bloomberg. So very legitimate stuff. This is old. This was May 27th, but Florida signed a bill into a law allowing people to make transactions using gold and silver. So gold and silver is being remonetized. I mean, nobody's doing it yet. Do you have to make them at face value on the coins of $1 for a silver eagle and $50 for a gold eagle, which is crazy? Or can you make them at the current spot price? That would be awesome. Here's the Ron DeSantis announcing it. Gold just broke 500,000 yen in Japan. The yen is getting torched, and gold is going vertical. Japan's debt to GDP is the worst in the developed world. Their only option, print or collapse. Either way, gold wins, and that is absolutely true. And gold in Japan has tripled since the beginning of this chart. In just the last 5 years, gold has tripled in Japan. You may have heard Rick Rule say that global allocation to gold has dropped to 0.5% in recent years, while the multi-decade average is 2%. Now, I've heard and seen measurements where gold was actually 8% of global financial assets when it was in a bubble in 1980. So a mere reversion to the mean would quadruple investment demand for gold. A reversion to a bubble like 1980 would be 16 times the investment demand. So the price would have to go astronomical. Well, here's the evidence it may be starting. Hong Kong investors triple gold holdings in rush to save haven, according to Hong Kong Shanghai Bank Corporation.
Mike points out that silver remains an extreme bargain at around $40 an ounce when compared to its inflation-adjusted 1980 high of $1,640. At the same time, questions about the accuracy of official inflation data have grown louder. Analysts like John Williams argue that government changes to CPI calculations in the early 1980s distorted the true picture of rising costs, which also explains why long-trusted financial models suddenly stopped working. Gold's steady rise since then, they say, simply confirms this hidden inflation and highlights how far the dollar has fallen since the Federal Reserve was created. Meanwhile, gold market dynamics reveal deeper cracks. The physical gold inventory has been flat or declining even as gold prices make new highs, raising suspicions that major players are quietly pulling gold out of ETFs. On the political front, Trump has floated bold ideas like issuing gold-backed treasury bonds to challenge the Fed's authority and restore confidence in the dollar. Calls to audit America's gold reserves are also resurfacing, as many now frame the issue correctly. It's not so much that gold is skyrocketing, but that the US dollar has been relentlessly devalued and is today worth just 1/3,300th of an ounce of gold. Now let's revise the interview.
Silver, look at where it sits. It is an extreme bargain at just about $40 an ounce because the high in 1980, inflation adjusted, is $1,640. Bam. So moving on, this is, John sent me these recently. This is the Consumer Price Index. This is the original one, the blue line. This is the CPI starting in 1982, where it diverged from the original CPI. And like I said, the truth lies somewhere in the middle. But when I spoke with John, he believes that gold is just corroborating his assumptions because he was an actuary and his models all stopped working after 1982. And he was trying to figure out why something that had worked for years and years and years just suddenly stopped working. And when he investigated it, it was because the government, the Bureau of Labor Statistics, started fiddling with the way that CPI is calculated. And so he also provides, this has some critical dates. The Federal Reserve, Roosevelt abandoning gold, Nixon closing the gold window, and the CPI reporting alterations started right there. And then he also publishes a much longer term chart, taking it all the way back to the colony, the U.S. colonies, the American colonies, not the U.S. didn't exist yet. 1665. And you can see what happened because of that green dot, the Federal Reserve. Something evil has transpired. Eric Young, again, GLD, gold inventory tonnage versus the gold price ratio at its lows. So this is it, and it just shows I don't trust GLD. The price is going up, the tonnage, is sort of flat. That causes the ratio to go down, meaning that the gold price is making new highs while GLD physical gold inventory is hovering at its intermediate lows. Who is sucking physical gold out of GLD? Thanks, Nick Laird, for the wonderful charts. So gold charts are us, or on X, it's Goldfish charts. Moving on, gold revaluation, Trump's red button option. And Trump eyes radical gold idea to expose the Fed and anchor the dollar. And this is about issuing gold-backed U.S. Treasury bonds. Forbes talking about the secret weapon Trump can use to take on the Fed. And he keeps on trying to take on the Fed. The logic of auditing America's gold, the measures reintroduced in Congress, is aimed to restoring confidence in a greenback, the value of which has plummeted below 1/3,300th of an ounce of gold. I'm glad that people are starting to finally state this in the proper terms, that the U.S. dollar has been devalued and is now only worth 1/3,300th of an ounce of gold. That it's the dollar falling more than it is gold rising. Now, gold will rise in value during these periods of time when it's basically revaluing itself.
In short, gold and silver are no longer just safe haven assets. They're becoming central to a global financial realignment. From China's bold mandates to structural cracks in paper markets, the stage is being set for a historic revaluation of precious metals. With supply constrained and demand surging worldwide, the question isn't if prices will rise, but how fast and how far they'll go. Do you think China's gold mandate could trigger similar moves from other countries or institutions? Is silver, with its extreme undervaluation, the more explosive opportunity compared to gold in this coming cycle? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.
I think a jump probably to, I expect conservatively at least 10% more by the end of the year, which would put us at 44, and perhaps 20% more, which would put us at 48. Time will tell, maybe this is going to sell off really quickly and we only get, couple days above 40. I doubt it. I think the momentum is in our favor. It's after, I'm laughing, it's after Labor Day. Historically, we see strength into the final quarter of the year. We're not there yet, but we're getting there. So and the miners, and I want to talk about that quite a bit, but the miners are something that really are assurance that we're in a true bull trend. I want confirmation. I want not only the miners to do well, I want them to do better than the metals. I want to see that 2 or 3x eventually, where they outperform by a factor of, 3x, for example. So if gold moves up 10%, top tier miners are moving up 30%.
Silver is up 42% this year, outpacing gold and marking its strongest 5-year rally, fueled by industrial demand from solar, EVs, and electronics. HSBC raised its outlook, citing a growing supply deficit of 206 ounces in 2025. Analysts agree silver remains undervalued despite big gains, with momentum pointing to $44 to $48 by year-end. Mining stocks, especially juniors, are already outperforming, offering leveraged upside as investors rotate into the sector. David Morgan, widely known as the Silver Guru, is a seasoned precious metals analyst, author, and founder of the Morgan Report. He points out that silver's momentum is building thanks to institutional buying, industrial demand, and algorithm-driven trading that continues to push prices higher. Despite heavy short positions, the trend has turned positive, with momentum indicators signaling strength. Gold has already broken out, while silver, being a smaller market, tends to move more sharply once momentum takes hold. Historically, miners often led metals higher, but this cycle has been different. Metals surged first while miners lagged. Now, strong earnings and value recognition are finally fueling a rally in gold stocks. Silver stocks remain trickier since most companies are not pure silver plays, often producing other metals alongside it. Still, silver miners can command higher premiums in bull markets because of silver's volatility and popularity at the top. David recommends that traditional valuation metrics like PE aren't the best for miners, as free cash flow and balance sheet strength matter more. According to the Morgan Report, well-positioned mining equities, starting with blue-chip producers and selectively adding speculative plays, offer some of the best leverage in the resource sector, especially as demand for metals like copper, lithium, and rare earths accelerates. As we begin the video, don't forget to hit the bell button and subscribe so you don't miss any updates. Please leave a comment below and give us a thumbs up if you found the article interesting. We appreciate your feedback.
As I've said before, and it sounds trite, but it is true, and that is there's more buying pressure than selling pressure. And there's been a rather large short position in the silver market, as there usually is, but we all know that the market is set as a derivative. The price in the futures market, which dictates the spot price and what coin dealers sell their metal for, and et cetera, is determined primarily by algorithms. And so at certain levels, certain things happen. And I have to defer to Michael Oliver, and Michael does momentum, and momentum is very important. Being an engineer, momentum is defined as mass times velocity. So like the whole idea of changing trend with a ship in the ocean, if you have a huge ocean liner, that's a lot of mass. So it's hard to change the direction of it. And the way you do that is slowly. That's how these major trends can change at times. The point being is that the momentum is in our favor. The algorithms are saying buy, and the institutions are buying it mostly for industrial purposes. Yet we do see entities such as Russia that's allocating silver. And you're also seeing on the gold side where China says that their insurance industry can allocate up to 1% in gold. So there's a lot more momentum in a lot of ways in both these markets. And silver, being a smaller market, gets a larger move than gold once the momentum starts. I've been in this market more than 40 years, and I'm still learning. And historically, the miners will usually lead the metal. And I say usually because, and that's a tip-off for somebody that's, studied these markets. Like, these gold stocks are moving, but nothing's happened in gold. We're probably going to see a rally here. Well, that did not take place this time. The opposite occurred. We saw the metals, especially gold, take off, and the miners were lagging. And I think it has to do with a lot of things. But one of them is that the market is much more sophisticated, a lot more computer trading, a lot of algorithms out there that do the trading. And the other thing is the value investors still look at one thing primarily, and that's earnings. Now, the earnings in the gold stocks have been phenomenal, but it hasn't equated into the price of those companies because many of these companies are trading as if gold is at $2,000 the ounce when it's been at, roughly 33 to 3,400 for 4 months in a row consolidating. And that information is now going where? Into the algorithm, into a trading desk, into a hedge fund manager, into the general public, into a whatever, pension fund. And wherever it goes, that knowledge is saying, hey, I'm a value investor. This is a real value play. This stock has got to eventually catch up to the earnings that it is providing that we know we have. And so that is what I think fueled the rally in the gold mining industry. Silver lagging, but silver actually is a smaller market, as we know. There are very few pure silver plays. If any, there's really one silver stock I could think of that's more or less pure silver play. The rest are silver plays, but they have, lead or zinc or copper or gold or something combination thereof. They're still silver stocks, but they get a bigger margin than gold. For example, at the top of the market previously, we saw a PE of a top tier gold company sell at like 30 PE, but an equivalent silver company would sell at a 50 PE. Well, why? Well, silver is more volatile, and I guess it's more loved at the top of a market than gold is.
I'm not finding it in the comps table. I was curious where we're at in terms of valuations for the major miners, but also some of the smaller producers. Like, where do you think we're at right now? Do you have an overview?
I don't. I know we're below that, I think, in some instances. I do want to make a caveat here because a PE is not a very good metric for a mining company. I mean, there's a couple big books back there that are hard slogs, and valuing a mining company is much more about free cash flow than it is a PE. PE is useful at the top of the market to get an exit strategy. Can be used, but it really isn't like a retail store selling, women's clothing or, grocery store, what have you. It's not a good metric for a mining company, but people use it. There's nothing against it, but it really isn't the best metric. So I just want to get that into the record because, that's what we do primarily at the Morgan Report is analyze mining companies, not just gold and silver, but, lithium, cobalt, the rare earth elements, the battery metals, you name it, copper. I'm becoming much more bullish on copper than I was, let's say, 6 months ago. So there's a lot happening in the resource sector. And one of the best leveraged plays you can do with lower risk, not no risk, is in the mining equities. And if you start with blue chips and work your way down into a speculative section where you basically make the correct bets, meaning how much money you allocate to each tier, you can do quite well and have a balanced risk-to-reward profile.
David mentions that in Elliott wave theory, the third wave is usually the strongest and most dynamic, marked by the sharpest price gains in the shortest time with heavy trading volume. This stage reflects a major shift in psychology, moving from disbelief to broad recognition as more participants enter the market. Currently, silver seems to be in the early part of this leg, with institutional and industrial demand driving momentum, while retail investors remain hesitant, especially those who only recently broke even. Asian markets are also playing a larger role than before, though retail silver buying there still lags behind gold. Looking ahead, this leg could bring the most powerful price appreciation yet, potentially lasting several more years. While past rallies, like the false start in 2016, failed to sustain momentum, the current setup appears stronger, supported by gold's breakout well above $2,000 and holding near $3,500. David predicts that the coming days will confirm whether this is a genuine breakout or another fake-out, but the fundamentals and market psychology suggest silver could now be entering its most explosive phase. Let's move into the interview.
That wave 3 up, there's 5 waves in Elliott, is usually the strongest and most dynamic move in the sequence. It's where the leg prices cover the largest distance in the shortest amount of time compared to the other waves. It often has the heaviest trading volume. It tends to be the longest and most powerful wave, though not always. It's driven by a big shift in market psychology, which we just discussed, disbelief from earlier stages, followed by recognition and enthusiasm as more participants jump in. So since I think we're in the beginning of that leg, we're seeing more and more participants jump in, but we still have a fair ways to go, meaning that retail that's given up on silver, maybe not silver stocks, but very few retail investors that bought even in the 30s are buying in at 40. It's like, I've broken even or I'm slightly ahead. Let's see how far it goes. But institutions need it, or industrial users need it. And so that's fueling the market. I think the Asian markets are more involved than they were in the past, although silver is not nearly as bought on a retail level in the Asian markets as gold is. Regardless, we're seeing that momentum change. And I do think that we're going to see, as it says, probably the most dynamic move in price appreciation in this last leg up. And again, where does it go? I'll say probably a couple more years. And just to be sincere, I have said, we got a couple years left, more than once, and probably as long as 5 years ago, and I was wrong. But, whenever you stick your neck out, it can be chopped off. But the facts are backing me up now. There was a false start, I believe, in 2016. I can, talk about that. I don't want to, but there were times when it looked like we were going to break into the next leg up, and it really didn't carry through. This time, it's obvious. Gold is well above the 2000 breakout level. It's $1,300, $1,400, $1,500 above that. Almost not quite a double, but from 2000 to 3,500 is quite a move. And it sustained it, and we're breaking out of that consolidation. Remains to be determined if it's a breakout or fake out. We have a couple more days to watch. But no, it's exciting times.
Silver appears to be entering a decisive stage where strong momentum, institutional demand, and shifting market psychology could fuel its most powerful rally in decades. With gold already sustaining record highs and miners beginning to catch up, silver's smaller market size and volatility suggest sharp moves ahead. Whether this proves to be the beginning of a lasting breakout or another temporary surge, the conditions look stronger than they have in years. Do you think silver can outperform gold in the next phase of this bull market? Will retail investors return in time to catch the biggest gains, or will institutions dominate this rally? We would be glad to hear your opinions, so please leave them in the comments area below. If you found this video useful, please give it a thumbs up and remember to subscribe for future videos. Thank you for joining us on this adventure.